In this example, we're going to put all of the items from Chapter 2 together. So we have a case study about a company that manufactures and sells surfboards. The owner of the company is in charge of the design and sale. He doesn't really maintain the company's records that well. He started the business with his own money and some investment from his family. It started it as a small business, and that now he wants to grow. He's considering a major expansion, and he needs to create the financial statements needed in order to go to the bank and ask for a loan. So we have a lot of information about his finances, and we need to create an income statement and a balance sheet for him to use for his records. And then we're going to look at his cash identity, his cash flow identity with the equations from Chapter 2. So we're going to start with a balance sheet. So for our balance sheet, we're going to look at 2018 and 2019. We have we have current assets and fixed assets, which is what this textbook calls the long-term assets. We add those together and we're going to get total assets. Then instead of a side-by-side, I'm going to do a long vertical balance sheet. So next will be our liabilities. We're going to have current liabilities and long-term debt. And then that gives us our total liabilities and our equity amount, and then our total liabilities and equity. We'll start with our current assets. So our current assets, if we look through this list of items, we see cash. We know cash is a current asset. We also know that accounts receivable is a current asset and inventory is a current asset. So we're going to add together cash plus accounts receivable plus inventory. And that is our total current assets. We'll also do that for 2019. So cash plus accounts receivable plus inventory. If you were doing a full balance sheet, you would list those items separately, but we're doing a summary balance sheet as shown in the finance textbook, so we don't need to go through the full list of listing them all separately. For fixed assets, we just have net fixed assets. So normally fixed assets would be listed and then their depreciation, they're shown net of depreciation. Again, we're doing a summary balance sheet. So we just need the total fixed assets net of depreciation. We add these together, then we get our total assets for each year. And we're going to do good form for a balance sheet. Even though we're doing a summary balance sheet, we can still do good form. Next, we're going to get our current liabilities. So our current liabilities, accounts payable, we know that's a current liability. So we can look and see if we have any other liabilities. Anything with the name payable is generally a current liability. So here we have a notes payable. So our current liabilities are accounts payable plus notes payable for each year. Notes payable plus accounts payable. Then we have our long-term liabilities or our long-term debt. We're given a lump sum for those amounts. And if we add those together, we get our total liabilities. And now we need our equity amount. Things that usually go into equity are any shareholders. This isn't a corporation. This is a small business. So the equity would be owners' contributions and plus retained earnings. So if we have net income, that's what's part of retained earnings. We don't really know a lot about the equity, just that he started with information from his family and friends. But we do know that our total liabilities and equity here has to equal total assets. So we know that those two things have to equal each other. That means our equity needs to be equivalent to total liabilities and equity minus our total liabilities. So that gives us our equity amount for each year. That's our balance sheet. Next, we're going to do income statements for each year. So we start with sales. We have cost of goods sold, depreciation, and selling and admin expenses. So we're going to start with sales. Here, sales. Our cost of goods sold. The depreciation expense. And we could have added all of those together and just done general expenses. Since this is just a summary income statement, we don't have to list everything individually. Okay. And we have our earnings before income and taxes, which is sales minus all of our expenses added together. We then have our interest expense, which gives us our earnings before taxes, our tax expense, and then our net income. Our interest expense, find our interest expense here. So we subtract our earnings before interest and taxes minus interest expense, gives us our earnings before taxes. Our tax rate is 21%, as given in the problem. So we take our earnings before interest and taxes times 21% to get our tax expense. We're actually going to round these up. And net income is earnings before taxes minus our tax amount. Now that we've completed the balance sheet and income statement for 2018 and 2019, we can do our other calculations. So the first question is, what is our operating cash flow for each year? So remember that the formula for operating cash flow is earnings before interest and taxes, or EBIT, plus depreciation minus taxes. So we're going to have our earnings before interest and taxes plus depreciation minus taxes. So earnings before interest, taxes plus depreciation minus taxes. The next item we want is cash flow from assets for 2019. And we do need a couple of different numbers in order to calculate these. So one thing, let's calculate what we have in dividends and our additions to retained earnings. So it tells us in the information that we pay 50% of net income as dividends to our current investors. So we take our net income times 50%. That means the other 50% goes to retained earnings. And I'm going to round those up just to nice clean numbers for the purpose of this problem. Now to take the operating cash flow and get our cash flow from assets. In addition to the operating cash flow, the cash flow identity from Chapter 2, we also need net capital spending and change in net working capital. Now we're only calculating these for 2019, so our cash flow from assets. Net capital spending is change, so ending fixed assets minus beginning fixed assets plus depreciation. So we're going to take our ending fixed assets from 2019 minus beginning fixed assets in 2018 plus our depreciation expense, and we want 2019's depreciation expense because we're calculating for 2019. And our change in net working capital is the difference in working capital from 2019 to 2018. So remember, that is current assets from 2019 minus current liabilities in 2019. That gives us our net working capital for 2019 minus current assets in 2018 minus current liabilities in 2018. So that gives us our change in net working capital. The cash flow from assets is operating cash flow minus net capital spending minus change in net working capital. So our cash flows from assets for 2019 is $14,054. The next number that we're looking for in this calculation is the net cash flow to creditors. Net cash flow to creditors is interest paid minus net borrowing, which is the change in long-term debt. So we have interest paid in 2019 minus, and we need the change in long-term debt from 2019 to 2018. So our cash flow for to creditors is negative 1,548. Now our cash flow to stockholders is dividends paid minus new equity raised. So we paid dividends of $42,760. The problem gives us our information about new equity raised in 2019. So our cash flow to stockholders for 2019 is $15,603.